Good afternoon, Quasar Markets Live, man. I've got a special one for us today. Listen, as you all know, I love Schwab Network, and we've got the senior market correspondent, Mr. Kevin Green. How are you, Kevin?
Doing pretty good. Obviously dealing with these markets, but a little bit of volatility could actually provide a little bit of opportunity in these markets as well. So I'm doing just fine. How about yourself?
Man, I love it. I think that's one of the things about the market itself, right? Is that we love volatility, we love volume and liquidity. If there's not that, then we can't get in and get out of the positions, right? But it does seem a little bit that you and I have been in these markets a long time, so this might be a little bit too much volatility for the new retail trader that just started in the COVID time, right?
Yeah, definitely. And that's what, it's unfortunate. I'm glad that we have a new cohort of traders that have gotten into the market since COVID. And then also the democratization of trading just in general. We can all now trade at our fingertips and leverage a multitude of products from the SIBO, from the CME, micro contracts, and all these things that actually get exposure. But I think the market over the last year and a half, 2 years, have gotten used to this V bottom type of recoveries. Anytime that we have pullbacks, we really haven't had any 10% pullbacks in the manner that we've seen right now. And so I think there's this thought in the market that, oh man, like, is this the bottom? Is this the bottom? Is this the bottom? And it's like, look, you don't need to call a bottom. You trade the markets where you have them right now, because by the time a bottom has been put in, we won't know until we're 60% retraced back to the upside and getting very close to all-time highs. So you got to be a little bit calm. In bear markets, if we are starting one, I can't say this is a bear market yet, but if we're starting one, look, these things can last for 8 months, 10 months, even 2 years at that for that matter here. So I would just say you gotta just buckle up, look at pockets of strength that are working on an intraday basis, follow those flows, get in, get out, and book it, and then go to the next trade. I think that's going to be the case here, but unfortunately, yeah, I think there's a lot of traders right now.
Let me ask you, Kevin. Not too long ago, I called the bottom. I said, "Here we are," and it's like it was back on the flush out, right? Look, I think when I look at it from my perspective, I've been trading 34 years, and when those flushes happen like that, I like those kind of flushes, right? Mm-hmm. So, but let's talk about you a little bit. How did you get started? I mean, you've got a pretty good background here.
Yeah. So very long story short, I grew up around the markets. My mom was in the finance industry, so second grade, third grade, when I wake up at CNBC at that time, watching Bob Iacchino and all these guys talk about commodities, and Jim Cramer, and then going to bed at night. That was the last thing that I would watch, and just kind of grew up in that type of environment. And then once I got closer to going to college, also kind of like playing poker, and it was kind of like, hey, there's financial markets. There's also, the speculative nature when it comes to playing cards. How can I actually build a career doing this? And so was able to get an opportunity to join the banking industry. I was a personal banker and a commercial banker for some time. I ended up getting my Series 7 license. I moved out to Arizona to become a broker for branches that did not have financial advisors. I did that for a little bit. I went out and actually had my own office location for Edward Jones. I hated that. Couldn't deal with it, the selling and all of that stuff. And then I joined Options Express, which was acquired by Charles Schwab. And at Options Express, we were a very small boutique firm, right? So not only just a derivatives broker, but I ran the short location, a reg show desk was what we really called it. I was the fixed income principal there. Got like 13 licenses. The list goes on and on. But I love options. I love derivatives. I love the markets just in general. But I mainly focus on options flow, market structure, and commodities. That's my kind of bread and butter.
Yeah, and I think in a lot of ways, that's how I started. I started in options first, and commodities futures way before I even learned the stock market. You're right, CNBC. I remember the days, right? Sue Herrera and Mark Haynes. I mean, that's way back. But I think when I look at the markets overall, you've also seen the as well, right? Is the change in fintech, right? How we started out. I mean, I started out with graph paper and pen for charting. Talk to me a little bit about the finance world as you started out in the computers and where we are today.
Yeah, so I started trading when I was in high school. So the only markets that I was able to trade were actually the Forex markets or currency exchange. So which is actually a very interesting market to get started in trading.
Yeah.
But when you can't trade during the day, you know, we had Nextels back then. You know, you had the chirp and all that stuff. We weren't doing anything on the phone, so I would actually just trade and swing trade overnight. You know, at that time we still had the platforms; they were kind of really basic. But MetaTrader 4 was actually the platform that I started trading on. And you were able to kind of build out algorithms and indicators and stuff like that. So I kind of got into the computer, you know, aspect or the computer programming aspect of the whole business here. And then if you're trading Forex markets, there's two things. One, obviously there's a lot of money. It's the largest and most liquid market in the world, even actually more than treasuries at this point, just based on just pure dollar flows. And then, you know, central banks, they won't tell you when they're actually making a move, and they can wipe you out fairly quickly here. So learning technical analysis by trading those, as well as risk management was a very big and key thing here. And it's just continued to evolve. And, you know, it's kind of that exponential growth that you're seeing just in fintech alone. And I actually like seeing that. I actually like seeing some of it's kind of a little, you know, you keep your eye on it. Like some of the products, the meme coins and stuff like that, kind of getting a little bit out there. It's just not my jam. But hey, if you profit off a trade and stuff like that, by all means, I go ahead and trade them. So that's kind of what I've seen as far as that evolution. It's just everything's so quick, and that's why I think a lot of these dips have been bought so quick as well. Because we haven't had any structural damage as far as like major credit or risk events and things of that nature to really kind of create a cycle.
Yeah, and I think when you look at it from the perspective of the options markets in general, the derivatives on your side, zero DTEs, as I call them, death contracts, they have really had a profound effect on the markets. And you've seen that over time. So tell us a little bit about what your thoughts are on the zero DTEs.
You know, I'm a fan of the zero DTE market. Is there a lot of risk, and could you lose a lot? Yes, you can. But I think one of the initial fears that we saw, and the reason why everybody's like, "Oh man, zero DTE options is going to blow up the market," because I think they felt that, you know, retail traders would not be responsible enough and kind of go short calls and all of this stuff. And that's not really the case. A lot of the zero DTE flows that you're seeing from retail traders are going long either calls or going long puts, or they might be doing some, you know, selling spreads and things of that nature, right? Risk defined for the most part, even though it can, you know, lose a lot of money with it if it goes in the wrong direction, especially in a volatile market like this.
Right.
But the other side of that, though, Stephen, is with the rise of zero DTE and let's say 60% of flows right now, 65% of flows. Yeah, I think 65% on average of flows are going to same day expiration. It's a vol dampener. It has become a vol dampener. And I think that's another reason among a multitude of them, right? Fiscal spend, monetary policy, yada, yada, yada. But you know this better than I do, probably. You know, I watch the VIX and I look at vol term structure, and vol term structure has not been the same ever since. You know, even the VIX right now, I mean, people are freaking out about these pullbacks, and I'm kind of looking around. I'm like, we can't even pop a 30 handle on this thing right now. What are you talking about? So you're starting to see implied volatility. If you're just looking at the VIX itself, implied vol is actually being priced lower than realized vol on consecutive days, which is really not normal. But I think that's because, once again, the VIX is not really taking the zero DTE into account when you're looking at that calculation. So I think it's actually a vol dampener. And then I think a lot of institutions have been able to recognize, hey, I can get a lot more tactical with hedging my positions or collaring my positions instead of having to worry about theta decay on a quarterly option or a monthly option. I can just do same day, and that's what you're also seeing is a lot of these. You know, to start the day, it's 150 points out, top side and downside, and people are just kind of playing the wings there.
But Kevin, do you feel that the new retail traders, and I'll call them all the way from COVID, do you think they understand the Greeks? Do you think they understand theta decay and rho and vega? Do you think that they're deep dark into the understanding of those volatility?
I think they're getting a better understanding of it. Here's what I kind of say. You got to learn as much as you can about derivatives, but you can go too deep into the weeds where it creates paralysis to trade. And I've noticed that as well, right? You know, if you know the basic Greeks, that's great. If you want to know second derivatives of these products, that's great. But once you kind of look at, you know, Vanna structure, and then you add charm to it, which is, you know, time value, you know, premium that's being run off, or risk that's in the market, and you add gamma to it, and you add this, that, and the other. You're looking at it, and you're doing so much analysis where it's like, dude, just press the button. Like, you want to buy this thing, you want to sell a spread, or you don't. So I think you need to at least learn, you know, delta, gamma's a really good one, vega's a really good one as well. But once you kind of get really into the weeds of charm, unless you're managing a very big portfolio, some of that stuff, it's nice to know, but I don't think you have to implement it on a day-by-day basis. Like if I'm trading a one lot, do I really care about charm? No, I don't. No. So that's why I say balance it.
You do care about interest rates, right? You do care about row, right?
Yeah, but row, at the end of the day, rates will stabilize.
Yeah.
Right, and once we have stabilization in rates, everything else within the option structure is going to re-rate itself or normalize.
Right.
So, am I concerned about row? Not really. I mean, initially, if you have a massive drop in interest rates, or massive rise in interest rates over a short period of time, yes, it could have an impact. But if you're talking about a swing trader,
gotcha,
that's probably swinging these things or doing zero DTE.
Let's talk about that swing trader. That person needs to be glued to the Schwab network and to Twitterverse and all kinds of stuff, because we never know when Donald Trump's going to tweet something, right?
Yeah. You know what's actually kind of funny about this, and I'm not going to get into the politics of anything, right? But, you know, before, all right, so we had the election, right? And the election, you know, it looked like Donald Trump was going to win. Boom, he wins, he sweeps, and now markets just rally, and they're like, man, this is going to be great. This is sunshines and rainbows. And like I said, I'm a commodity trader, right? And so the equity market is like, to the upside, to the moon. You know, everybody, this is going to be great and yada. And as a commodity guy, I'm like, did you guys not realize what happened the first time around? Not that it was, it's just a different environment. It's just a different environment. You get a tweet at 2:00 in the morning, China, you know, tariffs and this, that, and the other. And then China's not buying, you know, we're not going to buy soybeans from you. And then soybean markets fall off a cliff, or crude oil markets fall off a cliff. So it's I don't miss those days of the tweets and the intraday vol, especially on the commodity front. But it's something that we're going to have to get used to, unfortunately, and we will. You're actually starting to see it this week.
I agree.
A lot of the comments, tariff policy. Oh, like, I'm going to raise them up 50% for aluminum and steel tariffs. And Mark was like, oh, okay. And they were like, oh, we're going to cut them back down. And that was yesterday. We saw that nice little intraday pop before the fade. Once again, Mark is like, okay, at some point, it's going to be like the little boy that cried wolf. And I'm not saying him in general, but it's going to subside as far as his impact on how and propping up a market or dampening a market. Bitcoin announcement, pop fade. Tesla pop fade. It caught a little bit of a bid, but even just the initial announcement pop fade. So you're starting to kind of see that it's not having a very lasting effect on.
So I guess what you're saying is, at some point we're going to ignore things that come out of the White House. Is that right?
It's not going to be as much of an impact.
Right.
I will say we won't ignore it. We'll still be glued to it, but it's going to be like, are we going to take over Canada? Like, you know what I'm saying? Yeah, Greenland. Like, are we going to take Greenland over? Like, 90% of the market right now, 95% of the market right now is like, okay, he's just talking.
Right. And let's talk about talk. We got another guy that talks all the time, at least once a month or more, and that's the guy that wears a purple tie mostly. Powell. I mean, Powell has been pretty quiet the last few weeks, right?
Yeah, well, I think they're in blackout period right now. You know, Powell, the Fed just in general is going to be in a rock and a hard place. Now, the CPI number that came in today was obviously better than the street's expectations in some respects. And so I think that probably going to be a little bit of a feather in the cap. Now we have PPI tomorrow, and some of the PPI components translate into PCE. And PCE, once we get after PPI, we'll have 65% of the components of PCE, give or take. And analysts are pretty good at actually hitting that number. We usually don't miss it either to the upside or downside by that much.
Right.
But they're going to be in a rock and a hard place. And if we don't see a crack in inflation very, very soon, you start having this conversation of, do you cut rates because of other factors, tariff policy, labor market, potentially falling off a cliff here, consumer spending starting to contract or slow down, decelerate. And that's a hard thing, because the last time that we were in this type of environment, let me just preface this, the inflation is not as bad as what we saw kind of in the late 70s, early 80s, right? Not as bad, but it's the same type of environment. Do I actually cut rates right now, knowing that we're not really fully to our target and we're still seeing pressures in real estate? And well, the prices, OER is saying that we're seeing pressures there. You are seeing cracks in real estate. And if they do cut, does inflation kind of come back into the picture? Do you overheat the economy? Does something else happen? So there's a lot that's kind of there. So I don't envy the job. I only, the man doesn't get paid enough to have that stress hanging over his head every single day. I can tell you that.
And I look at it from the perspective of the data that he's looking at. And in the previous Treasury Secretary Yellen, she loved the JOLTS numbers, the job opening labor turnover survey numbers. And it doesn't seem that Bessent really has a specific key points that he's looking at. Today, the new Treasury Secretary talked about tariffs a little bit. He talked about that he's more interested in business. What is it that you want to see out of the new Treasury Secretary that we didn't see in the past Treasury Secretary?
Look, I mean, the Treasury Secretary's job, guys, is to sell our paper. That's it. So I want him to say things that's going to make people want to buy our paper and not have to rely on a Fed cut. It's really that simple. I hope that he kind of stays in his lane when it comes to managing the Treasury and don't. It's the only thing that I get a little bit concerned about right now with this new administration. Somebody's head of one agency or department, but their hands are in like 4 or 5. They're making policy on 4 or 5 things that are not really in their scope or purview. And I think that gets a little bit dangerous when it comes to the messaging, but his job is to sell our paper. And so that's all I care about, as long as he can talk about the strength of the United States. Also, hopefully this tariff policy thing passes fairly quick and we regain a little bit more trust with our allies and friends and trade partners. I think we need it. There is some damage there that I'm a little bit concerned about, just long term, not like something that's gonna sell off the market tomorrow. But you start getting the concern here that, hey, maybe they're not going to be reliable partners, or they're going to change on a dime, or they're going to want more, and this, that, and the other. Once again, don't care about the politics. That can have a profound impact in adjustment of trade relations. And I just want to provide an example of this so people don't think that I'm leaning one way or another. Once again, I'm a commodity guy. You go back and you look at the 2017, 2018 tariff battle between China and the United States. First thing that China did is hit our agricultural, our exports. And then what happened? We had this tit for tat. They come to this resolution. They sign a non-binding agreement to be able to purchase more grain and agricultural products from the United States. And they fulfilled all of maybe 15% of that commitment till this day. But what also happened? China improved their relationship with Brazil and Argentina, and that's where they're actually getting the bulk of their grains now. And we're losing market share there, and that's the direct result of that first. And
they're doing the same thing in Africa too, right? I mean,
Africa is another thing. Even if you're looking at the Middle East and Syria and things of that nature. But I get back to kind of like the grains. It's a very small part of just agriculture and in general. It's a very small part of our overall economy if you're looking at the totality of it. But it does actually have a major impact when it comes to jobs and then also smaller farmers, which I grew up in farmland. So I have sympathy for those smaller farmers that they're not able to. In Sugar Grove, Illinois, right outside of Chicago. It's got a little bit built up now, but the thing is that a lot of farmers, people look at the farms and say, hey, man, those guys are millionaires. A lot of them are not. I mean, sometimes, especially in Illinois, you're getting 30, 40% of your crops are being subsidized in one way, shape, or form from the government, because they're growing corn there that's not actually consumable corn for a human body. It's really for ethanol and grains. So they just can't go without a season. And so these tariffs are hitting right now, and you're seeing these readjustments happening in real time. But it's not like you can say, oh, let me go ahead and plant sweet corn now. It just doesn't work that way. And
I grew up in Southern Illinois myself. I grew up near those cornfields, and I watched them, pigs and hogs and cattle, though. I traded them all the time. So I love it. Yeah. All right. Well, I'm going to ask, there's another brand new red Tesla sitting on the front lawn of the White House, owned by a company called Tesla. And Elon Musk has had quite a bit of influence with Doge. Are you watching anything going on with Doge in the White House, with the tariff situation and with cuts in the government?
Yeah, I think we won't see the immediate impacts right now. This will be something that's going to be 6 months down the road. And when it does happen, it's going to actually hit the private sector first before the government's jobs. And that's going to sound very odd, but you have this 2-to-1 ratio, consultants to government employees. So the consultant side of the equation is going to be reflected in initial claims, and then also going to be the monthly jobs report. That probably will raise the unemployment rate. I don't know how fast it's going to raise it, but it will have a little bit of an impact. Labor supply will increase. That should actually then depress wages itself, right? It makes a little bit more competition. You go from a situation of tariff policy that becomes very inflationary to now, these government cuts, which are deflationary in nature on multiple fronts. The scary part about this whole thing is and you correct me if I'm wrong.
Okay.
I'm a student of history. I've never seen the government plan anything right on both sides.
Never.
The amount of cuts or the amount of increases when it comes to spending. So the thing is, this is an experiment, and it's an aggressive experiment that we're going to hope that goes right. And the biggest fear that I have is that they get too aggressive with it. They cut critical programs. I think they're already kind of seeing, we got to back this up. But they cut too much, and then there's no desire on the fiscal side to get us out of a recession. Right. That's the biggest fear, because time, that's what you need. The Fed can't do a lot. The Fed can't do too much when it comes to trying to get us out of a recession. Could they cut rates? Yes, but they're going to have to do QE. And no one wants to do QE.
Nobody wants to do QE at all. You're absolutely right. All right. Well, I'm going to leave you one question. We're getting very close to the baseball season. Are you a baseball fan?
I am not a baseball fan, but I'm a Chicago fan, and I'm a Sox South guy. Sox guy. So
I'll let that go. I'll let that go. I'm a Cardinals fan, so I'll let that one go. I love Chicago, and I look forward to seeing you in Chicago, Kevin. And Kevin Green, the senior market correspondent at Schwab Network. You can see him almost every single day. I love listening to your commentary, and you're on Wolf Financial as well. And I look forward to having you on again, Kevin.
Appreciate you. Thank you for having me.